Welcome back to the Global Ledger. I'm Justin. Today we're going to talk about something that quietly frustrates investors, traders, analysts, and even policymakers. Often, even without them realizing it. You look at the data, earnings are strong, GDP is holding up, inflation is cooling, and yet markets fall, or surge, or behave in ways that feel completely disconnected from the fundamentals. So people ask, what am I missing? Why didn't the market react to the news? Why does bad data sometimes push prices higher? The answer is uncomfortable, but simple. Markets don't move because fundamentals change. They move because liquidity does. Today, we're going to unpack what that really means. Let's get into it. I want to talk about the fundamentals myth. Let's start with a deeply ingrained belief that markets are primarily pricing value. That prices move because information arrives, earnings, inflation prints, economic reports, and the market updates, its expectations. This is how finance is usually taught. But here's the problem. Fundamentals explain why something might be worth owning. They do not explain when prices move. Markets can ignore fundamentals for months, even years, and then suddenly react violently without any new information at all. If fundamentals truly drove price action, markets would move smoothly and rationally. They don't. They gap, they freeze, they cascade. That tells us something else might be at work. And I would say markets are funding machines. Okay, so to understand price movement, you have to stop thinking about markets as valuation machines and start thinking about them as funding systems. Every asset price sits on top of a balance sheet. Every position, stocks, bonds, derivatives, real estate, requires funding. And that funding depends on the available cash, collateral quality, risk tolerance, and the capacity of balance sheets. When funding is easy, markets feel calm. They feel rational and forward-looking. When funding starts to tighten, markets become reactive, unstable, and violent, even if fundamentals haven't changed at all. Liquidity really is the oxygen here, and without it, nothing really takes a breath. So why liquidity moves prices first? Liquidity operates before valuation. And here's why. When liquidity is abundant, you'll see increases in leverage. You'll see risk spreads compress. Marginal buyers keep bidding prices higher. Not because assets suddenly became more valuable, but because capital is searching for a place to live. So when liquidity tightens, leverage is pulled back, positions are reduced, and assets are sold to meet funding needs. Not because fundamentals collapsed or anything like that, but because balance sheets needed some repair. This is why markets often fall before recessions show up in the data, and why they often boom before fundamentals improve. Liquidity leads, and I think fundamentals follow. And here's why news misleads people. And it's really where confusion starts to set in a little bit. People expect markets to react to headlines. But headlines are usually about growth, inflation, earnings, employment. Liquidity stress doesn't announce itself in press releases, and I've seen this as well. It shows up in funding rates, bid-ask spreads, repo conditions, dealer balance sheets, volatility spikes, correlations going to 1. When markets sell off for no reason, it's usually because the plumbing is tightening, not because the story changed. By the time fundamentals look bad, the market has often already moved. And so the big mistake investors make, and the most common mistake, is assuming if the long-term story is good, price declines must be irrational. They're not irrational. They're mechanical. Liquidity stress forces selling regardless of conviction. Strong fundamentals don't protect you from forced deleveraging. They only matter after balance sheets stabilize. This is why understanding liquidity doesn't make you pessimistic. It makes you realistic. So how do we see markets more clearly? Once you accept that liquidity drives price action, everything sharpens. You stop asking, is this company good or bad? And you start asking, who is funding this position? How fragile is the balance sheet? What happens if funding tightens? You realize markets aren't emotional. They're constrained. And prices don't move because opinions change. They move because constraints do. I want to thank you for listening to episode 49. Or is this? Yeah, this is 49. Sorry. Episode 49 of the Global Ledger. We talked about, we didn't discredit fundamentals because fundamentals do matter, but they matter on longer timelines. Liquidity decides when markets move and how fast and how far. So if you want to understand markets, not just stories, you have to follow the flow of funding, not just the flow of data. And that's the difference between watching prices and understanding what's underneath them. Once again, I'm Justin, and thanks for being here.